If you have a health savings account or you're eligible for a health savings account, then you should watch this video as I'm going to discuss ways that you can earn more money on your HSA to really get the most out of it. Welcome back. This is episode 209. This week I'm discussing one of my favorite ways to save for retirement. It's probably not what you're thinking, and that is through a health savings account or HSA. Let's just start with what an HSA is, or a health savings account is, in case you haven't heard of it before, or maybe you don't really understand it. So many companies have gone to high deductible health plans, and many of those high deductible health plans come with the availability for an HSA account. And there's a maximum that you can contribute to that between what you put in your employer based on whether you're single or you're married or you have any dependents. So a single person for 2024 can put in $4,150. That's a combined contribution between you and your employer. So for example, your employer, as a benefit they give to you from going to a high deductible health plan, they give you $1,000 a year, then you could only put in $3,150. If then you are considered to be eligible for a family HSA, and that is whether you're married or you have any dependents on your health plan, then your limit is double the single. So now it goes up to $8,300. So again, that's between what you put in and what your employer can put in. And then if you're over 55, there's also a $1,000 catch-up. So you can add another $1,000 on top of the $4,150 or $8,300 that you can be putting into this plan. And if you're married, your spouse could also take advantage of the $1,000 catch-up if they were over 55. But to do that, they'll need to open their own HSA account, probably not through your employer. So we'll discuss that in a little bit, but that is something that both spouses could take advantage of. Let's just say both you and your spouse are over 55. You're both on the health plan and you're on a high deductible health plan that qualifies, then you can put in that $10,300. So that's a big benefit. So let's talk about the tax benefits. So these plans, the reason I'm so big on them, I'm such a big fan, is because they're considered a triple tax-free retirement account. Well, what does that mean? That means that when you put money into the plan, if it's your contribution, you're getting a tax deduction on those contributions. So that's reducing your taxable income. When the money's inside of the HSA, it can grow, it can be invested, which we'll talk about next, and that growth is tax-free. And then if you take the money out for health-related costs that we'll talk about also, that's also tax-free. So no other retirement account gives you that triple tax-free benefit. If you think about a traditional 401k, you do get a deduction when you put money into the plan, but when you take distributions out, that money's taxable. If you think about a Roth IRA or Roth 401k, yes, you can grow the money tax-free and take out tax-free distributions, but you don't receive a deduction on the money when it comes out. Now, you might be thinking, well, why should I be, putting money into this plan? Because I've heard that HSAs really don't make a lot of money. And that is true for a lot of people. But with an HSA, you can invest the money. So it really depends upon the option that you have currently available to you. Let's just assume first that your HSA plan is offered through your employer. So hopefully your employer offers a good HSA. And what would be a good HSA? That would be where they're giving you good investment options. They either allow you to buy individual stocks and bonds, or they offer a list of mutual funds that you can pick from. Hopefully that list has a lot of low-cost, index-based mutual funds like the S&P 500, the Total Stock Market Index Fund. Those are examples of good index funds with low costs, probably less than 0.1%. If they don't offer those to you, or it's mostly high-cost mutual funds, then that could be a reason for you to think about moving to another HSA. And the benefit of doing that is there are many other HSA providers out there where you can invest the money and you can choose from better investment options. So my favorite HSA provider out there is Fidelity. In my opinion, Fidelity offers the best HSA that you can pick from other than employer-sponsored HSAs. I will say when I look at HSA accounts for current clients who are still working, I do see a lot of good HSA accounts when it's with a larger employer. And again, defining good is that They offer a lot of investment options, low-cost investment options. The other thing is that what do they offer you on your cash? Meaning, let's say you are just getting started with your HSA. You're not quite yet ready to invest the money. You're just still building up some money to cover you in case you have a large healthcare expense, because at the end of the day, that's what the primary reason for this is. In that case, you want to be earning a decent amount of interest on the money just sitting there, not invested. And as we know, you can go to your local bank right now and put your money into a money market or CD, earn close to 4.5%, 5%. So if your employer plan isn't offering you that option, this is a reason why maybe you might want to transfer your account to another provider like Fidelity. Because Fidelity, the reason I'm another big fan of it is because not only does it allow you to pick from low-cost index funds, you can pick from individual stocks or bonds. You also, as a default, when money just hits the account, it automatically is swept into one of Fidelity's money market options. And currently those rates are around 4.5%. So it's not the best rate that you can get. You certainly could find a higher yielding savings account or short-term CD that would pay more than that, but you don't have to do anything. The money just goes in there and goes into this money market. So that anytime you want to make withdrawals or deposits, if you don't invest the money, it's going into this money market as a default. And that's why I think it's so good, because when you combine that with the low cost and almost unlimited investment options, it makes it an excellent place to have your HSA. So if you are eligible for an HSA and you don't like where your HSA currently is, so let's say your employer plan doesn't pay you much on your cash, because that's something I see all the time. This is just like many banks. How do banks make money? They hold your cash and not pay you interest on it, and then they lend it out to somebody else. But you don't have to play that game. You can take control of your money. So if your cash isn't earning anything in your HSA, or you don't have good investment options, it's a lot of high-cost mutual funds, then you could open an HSA with Fidelity. And if you Google Fidelity HSA, and I'll put a link in the show notes. Again, this is episode 209. So retirewithryan.com/podcast/209. You could then have a link to open the HSA with Fidelity. So you'd open it with Fidelity. And again, I don't work for Fidelity. I don't get paid anything. Probably should, because I've been touting their HSA for a long time. But I tout it because I believe it's such a great option for my clients. I personally use it myself. You could transfer money from any HSA over to another provider. So if you have an employer plan you don't like, let's say you open an HSA account at your bank and you're earning no interest on that money, transfer it over to Fidelity, and as a default, that will automatically be put in the money market and start earning 4.5%. Now, I'm a fan of a bucketing approach when it comes to your HSA, meaning you should have some money in short-term for short-term needs and for long-term, because as your HSA account grows, you're probably not going to need all the money in there for any 1 year, because remember, you're on a high deductible plan. So there's a maximum out-of-pocket limit with your high deductible plan in any 1 year. So that's the most money you'd have to spend. Let's say that was $7,000. Then maybe you want to keep $7,000 in your HSA in a cash option. So if you use Fidelity, that could just be left in the money market. You could choose another short-term bond fund. You could buy a short-term CD, whatever you want to do, but that's your short-term bucket, and the other money is your longer-term bucket. That's going to cover your health-related expenses later on, or for other expenses that you choose to use the money for. So I like a bucketing approach when it comes to the HSA. So for that longer-term money, that's where you'd probably want to invest most of that in stock index funds, or if you like picking individual stocks, you could do that too. And that way, that money could grow, and that would be your longer-term bucket. So if you're following this strategy with the HSA, to really get the most out of the HSA, you want to let the money grow. You want to let your principal earn interest grow, so that down the road, you're just spending your gains and you're leaving your principal in the HSA. So the best way to do that would be to pay for most of your HSA-related expenses out of your pocket, not with your HSA. Probably the biggest mistake I see people make is that when you get your HSA, you get a debit card and you start going to the doctor and you're using the debit card, and you're doing a good job because you are getting a tax benefit on the money that goes in, but you're not getting the growth. You're not getting really the tax deferred growth that you could be getting on that money. So what's better is that you instead leave the money in your HSA if you can, and you track those expenses as you go forward. So when you become eligible for the HSA, you start tracking those expenses. You could put it in an Excel worksheet, Google Sheets, whatever is best for you. And then I would keep the receipt as well in case you ever get audited by the IRS. And that way you start a running tally of how much you've spent. So this is what I do with my family. We've had an HSA account for about 6 years, and I've been tracking religiously those expenses. It's a little bit of work, but I keep the receipts, and when I pay medical bills, I put it into my sheet, and I know, okay, let's just say, for example, we've spent as a family $15,000 on health-related expenses over the last 6 years, and our HSA account is worth $30,000. If I wanted to, I could reimburse myself at any point for those $15,000 of expenses, and that is tax-free. Again, that's a tax-free reimbursement because these are health-related expenses. If I wanted to take out the other $15,000, well, taxes or penalties could apply because that's not health-related expenses. But this is why I suggest tracking what you're using the money for. So the IRS has a whole list of things that qualify for HSA-related expenses. You can imagine going to the doctor, co-pays, prescription drugs, surgeries, right? All medical bills, even preventative things like Band-Aids, sunblock. There's a whole list that the IRS has. And then additionally, you could potentially use your HSA to pay for insurance premiums, to pay for health insurance, or potentially even Medicare supplemental insurance. Now, let's say you don't use all your money up by the time you turn 65 in your HSA, and you've got a nice balance in there. You can always take the money out just like a 401k once you turn 65, and you would just pay income taxes on it. So even if you don't use it for health-related expenses or you don't think you're going to, it'll act just like a 401k. So it's another bucket to save money in. And that's why I think it's so great. So again, investing the money in buckets I think is a good idea. And then having a lot of the money in there be for a longer term so that it can grow and you can use that money to pay for your expenses down the road. So again, Fidelity, in my opinion, I think has the best HSA. I'll put a link in an article that's out there. Morningstar does a review every year of the best HSA providers, and for the last 4 or 5 years, they've rated Fidelity the number one HSA provider for the reasons that I mentioned. Additionally, you can connect the HSA to your bank account, and if you want to add money to it, you can do that. If you want to take money out, you can do that, and it's really easy. You also can get a credit card, but you don't really have to do that. So what are the action steps that you should take to make the most of your HSA? Well, in my opinion, you should fully fund your HSA every year. So whatever the limit is for you, whether it's a single plan, a family plan, if you're over 55, I would fully fund the HSA because of the triple tax-free benefits. Again, less anything that your employer puts in. So even if that meant you cut back on maxing out your 401k, I would do that. I would at least put the money into your 401k to qualify you for your employer match. But then I would go to the HSA to get that fully maxed out so that you have money in there. And then I'd make sure you had it invested, probably in this bucketing strategy. So if you check out your HSA, you have high cost investment options. And again, high cost, I would say, is that if you don't have index funds, if the index funds are more than 0.1%, the cost is too high. Or if you're not earning money on your cash, then consider opening an HSA account with Fidelity. You can transfer over your existing HSA into that. You can still participate through payroll deductions into your HSA because that's how most people contribute to an HSA, is through payroll deduction. That's a good thing. And then systematically, or once a year, you could transfer any remaining balances over to Fidelity if that's where you want to go. You want to use Fidelity if it's better than your current HSA. And then make sure the money gets invested. Don't just let it sit there. You've got to invest it. Fidelity does have a way that for a small management fee, they can manage the money for you, but I don't think that's really necessary. I think if you figure out what you're going to invest in with Fidelity, again, using index funds, they have a lot of index funds or something else, you can go in every so often and invest the money. The other thing is that if you find yourself at the end of the year and you haven't maxed out your HSA, you didn't realize you weren't maxing it out, or something happened with your payroll, you can always put in more up to the maximum by contributing directly to your account with Fidelity or another HSA provider. You just have to make sure you note it on your taxes so that you get the maximum tax deduction. So again, follow these action steps, fully fund your HSA, check out what you're earning if you're not earning a good amount of interest, check out the investment options, and if they're not good, then consider setting another HSA account up with a company like Fidelity and really get the most out of your HSA. So I hope this helps you to get more from your HSA, to earn more with your HSA. And as a reminder, as always, if you have a listener question, head over to retirewithryan.com and click on Ask a Question. I hope you have a great week, and I look forward to talking to you next Wednesday. Take care.